Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at CoreWeave.
If you find our talks useful, please consider subscribe, like, and comment underneath. It really does help us bring you more of this kind of analysis.
All right, so let's get into it. CoreWeave. This is a fascinating one.
It really is. We're talking about a company right at the heart of the whole AI boom, an infrastructure player with, frankly, just massive growth, but also huge spending and some pretty serious legal noise right now.
That's the perfect summary. We're going to unpack the investment thesis, look at the financials, the capital required to fuel this expansion, and really try to figure out if this litigation is a real threat or maybe just a temporary discount.
Okay, let's start with the fundamentals. The engine of AI demand. I mean, looking at the core story here, it's all about pure, aggressive growth.
It is. The whole reason to even look at this company is that insatiable demand for dedicated AI compute. I mean, look at the Q3 2025 results.
The $1.4 billion number.
Exactly. $1.4 billion in revenue. And to give you some context on that velocity, that's 133.7% growth year over year.
Wow.
This isn't a slow ramp. It's a vertical launch.
That speed is just staggering. But let's pause on the guidance because the full year number for 2025, that was between 5 and, what, 5.15 billion?
Yeah, in that range.
That was a revision, though. We have to be clear on that. Why did they lower it? Is the AI boom already fizzling out?
And that's the absolute essential question to get right. And the answer is no. Demand has not slowed down one bit.
Okay.
The revision was all about supply chain friction, just delays in getting the very specialized GPUs and power components they need to actually, bring the new data centers online.
So the backlog, the customer demand, that's all still there?
It's robust. The market is supply constrained, not demand constrained.
Okay, that clarifies the top line. But now we have to talk about profitability. This is where I think a lot of skeptics get hung up.
Yeah.
You look at the headlines, you see a projected net loss for 2025 of over $1 billion.
A $1.09 billion net loss.
Yeah, that just sounds like a disaster.
Yeah.
A company burning cash. How do we square that massive loss with the idea that this is a healthy business model?
You have to slow down and really separate two different ideas here. First is operating cash flow.
Okay.
The company is already operating cash flow positive. That's your validation right there. It proves the core service renting out this specialized compute. It generates more cash than it costs to run. The unit economics work.
So the model itself is sound. If that's working, then what is that billion-dollar net loss coming from?
That's just an artifact of the expansion strategy. It's the cost of building out future capacity. You've got massive infrastructure depreciation, interest expense on the debt for construction, all the pre-operating costs.
It's the cost of building the runway, not a problem with the plane.
That's a great way to put it. And what's more, you're already seeing signs of real operational excellence even during this build-out.
Like what?
Look at the margins. Gross margins are sitting at a very healthy 73.9%. And what's really interesting is that they actually improved their gross margins in Q3.
How?
Better power procurement deals, and they got smarter about how they allocate their most valuable chips. It just shows they're not just throwing money around, they're getting more efficient with this massive network.
That optimization really gives us a clear timeline then. These high-growth infrastructure plays, they always hit an inflection point where the investment starts to pay off.
And management's given us a roadmap. They expect EBITDA to turn positive by mid-2026.
And analysts are forecasting a swing to actual net profit into the black by the first quarter of 2027.
And that mid-2026 EBITDA positive moment, that is the single biggest catalyst for the stock. That's when the narrative shifts from speculative infrastructure play to profitable growth engine.
But getting there takes a monumental investment. This is where the risk story gets really eye-watering. The CapEx.
Yeah, let's talk about that.
The guided capital expenditure for 2025 is $12 to $14 billion. And if that wasn't big enough, they expect 2026 CapEx to more than double that.
That's the kind of scale that makes even seasoned investors, a bit nervous.
Nervous is an understatement. I mean, when you're spending at that rate, you have to be relying on financing. They've taken on a lot of debt, right? The debt to equity is what, 2.66?
It is. It's high. And if demand were to suddenly slow down, or if they stumble on the execution, that debt could become a huge problem.
Exactly. I really want to push on that. With interest rates being what they are, carrying that much debt against future revenues seems like the #1 risk.
Yeah.
So what is the actual concrete mitigation strategy here?
The mitigation is their disciplined approach. And honestly, it's brilliant. They have a policy where they only spend that immense capital on a build-out when the customer contracts are already in hand. Long-term, high-value commitments. Signed.
So they're not building it and hoping people will come. They're building it because Microsoft or OpenAI has already signed the papers.
Precisely. This contracted demand-first strategy completely de-risks those massive investments. They're locking in the revenue before the debt is even fully spent.
They're almost like a contract manufacturer for AI compute.
That's a perfect analogy, and it's what makes that 2.66 debt-to-equity number digestible in this case.
Okay, so let's shift from the capital to the competition. A lot of big players offer cloud computing. What is the moat here? What lets CoreWeave command these prices?
Specialization and utilization, that's the moat. Their infrastructure is purpose-built just for these GPU-heavy workloads. It's not a general-purpose cloud.
Right.
And because they're so specialized, they can achieve near 100% utilization across most of their data centers.
And how many do they have now?
As of Q3 last year, 41 operational data centers, and those places are packed. No empty racks sitting around.
41. That is an incredible physical scale to reach so quickly. And that utilization rate speaks to their client base. We're talking sticky revenue, I assume.
Extremely sticky. These are long-term contracts with the hyperscalers, your Microsofts, your OpenAIs, and big partnerships with Fortune 100 companies.
Like who?
We know CrowdStrike is using their platform for specialized AI cybersecurity agents. Rakuten is using it for complex visual language models.
So once you build your entire AI workload on their specialized hardware, the cost to switch is just astronomical.
It's too complex, too expensive to move. But they're also staying ahead on the tech side.
How so? What's the operational edge?
They're doing some really sophisticated stuff. For instance, they're rolling out next-gen liquid cooling systems across their facilities.
And that's not just a nice-to-have, right? That's a necessity at this density.
It's essential. It lets you pack more GPU power into the same physical space and manage the heat. That boosts efficiency, lowers your overall cost per compute hour. It's a huge deal.
What about the other major cost? Power.
Yep. They're deepening partnerships directly with energy providers to get off the volatile spot market. That stabilizes their cost of goods and protects that high gross margin.
So they're managing all the inputs. And I saw they made an acquisition, Monolith AI.
They did. And that signals they want to move up the stack, enhance R&D, offer smarter solutions on top of just renting out the hardware.
It's about controlling the whole experience for the customer.
Exactly. It moves them from just a hardware provider to a full-stack solutions operator, which locks in those clients even further.
Okay, let's pivot now. Because despite all these great fundamentals, the operational excellence, the stock price has been absolutely brutalized.
It has been a capitulation-style washout. I mean, a painful drawdown from the 52-week high of $187 down to where it is now in the $87 to $91 range.
That's a drop of, what, 50–60%? It's a bloodbath.
It is. It's just extreme bearish sentiment just took over and completely flushed out anyone who wasn't a long-term believer.
But that huge drop seems to have set up a bottom, maybe a technical inflection point. Just over the past week, the stock recovered pretty significantly.
It did. The jump of 12 to 16%, testing some key resistance levels. It's just the narrative might be starting to turn.
And the market structure itself could help if good news hits. The short interest is really high.
It's very high, 19.34% of the float. That creates the perfect setup for a potential short squeeze if a positive catalyst hits harder than expected.
But insiders, I saw some activity in January that looked mixed. The chief development officer, McBee, sold over $2 million in stock. That's always a red flag.
It is. It's natural to see that and be concerned, but you have to read the full filing to get the whole story.
All right.
At the exact same time, he converted a substantial number of his Class B shares into Class A shares. So in that context, it looks less like a bearish exit and more like a financial rebalancing.
So he's diversifying a bit, but still has huge exposure to the upside.
Exactly. We see that as a neutral signal, maybe even slightly bullish given the context.
Okay, which brings us to the elephant in the room. The thing that caused this massive drop. The litigation.
This is what's been driving the sentiment. Multiple securities class action lawsuits filed in January.
Right, and what are they actually alleging? This is the critical part.
It's all about execution risk. They're basically claiming the company overstated its ability to meet customer demand between March and December of 2025, and that they understated how much they relied on a single third-party supplier.
So this isn't about the business model failing or demand disappearing. It's about paperwork and disclosure around construction delays from a year ago.
Precisely. We see this as a near-term overhang. It's a legal and disclosure issue, not a fundamental breakdown. Management already talked about these delays months ago in their revised guidance.
But the market hates uncertainty.
The market hates uncertainty, so it slapped a heavy risk premium on the stock. But once this is resolved, and that usually takes 12 to 24 months, that premium should disappear.
And you see this reflected in the analyst coverage, right? It's cautious. Zacks has a hold on it. But the consensus price target is still way up at, what, $123?
$123.81, so about a 40% upside from here. The analysts see the underlying value. They just want the legal noise to go away.
Which is why the catalyst calendar is so important right now. What's coming up in Q1 that could change the story?
Two big things. First, the Q4 2025 earnings release, late January, early February. That is crucial for confirming the 2026 guidance and those massive CapEx plans.
And second,
the operational status of the Denton data center in Texas. This one is key because its delays were specifically mentioned in the lawsuit.
So bringing that fully online directly counters one of the main allegations.
It does, and it immediately unlocks a huge block of contracted revenue.
Looking out a bit further, what are the midterm catalysts for 2026?
The biggest one is a projected 45% increase in contracted compute hours by mid-2026. This is huge. It shows a major revenue jump is already baked in.
And that's happening right around the same time as the second catalyst.
Which is that critical EBITDA positive inflection point. That's the moment the narrative officially changes, and you'll see a whole new class of institutional money come into the stock.
Okay, so let's bottom line this. Let's summarize the risks and mitigations for everyone listening. Top risk is obviously execution. Doubling CapEx is a monumental task.
It is. But the mitigation is their track record. 41 data centers are already online, and that strict policy of only building for contracted demand.
They're building to fulfill signed commitments. And the second risk is the litigation overhang.
And our view is the mitigation there is that the core fundamentals are still intact. The sticky customers, the insane demand for AI. None of that is affected by this temporary legal issue. It's created a classic buying opportunity for patient investors.
This has been a very thorough look at a really complex situation. So after all that, what's your final assessment, the overall confidence score?
Our confidence score lands at a 7.5 out of 10. The fundamental story is incredibly strong. It's backed by this unprecedented AI demand, locked-in revenue. But, the immediate execution complexity and the legal noise, that keeps it from being a perfect score.
So the elevator pitch is, CoreWeave is the essential specialized GPU cloud provider for names like Microsoft and OpenAI. They have massive contracted revenue, they're on a clear path to profitability, and the current legal drama has created a compelling discount.
That's it, and this is absolutely not a short-term trade. The target horizon is a 12 to 24-month multi-year hold. It's for patient, growth-oriented investors who understand infrastructure and are comfortable with this kind of capital-intensive build-out.
And here is the final thought for you to consider as you apply this analysis. Since management expects a 45% increase in contracted compute hours by the middle of this year, a number already backed by customer commitments, how much of that massive locked-in future growth do you think the market has really priced in, given the current legal uncertainty hovering over the stock?
Thank you for joining us for this look into CoreWeave. We hope this analysis helps bring some clarity to what's happening in the AI infrastructure space.
Until next time, apply this knowledge wisely to your own wealth-building strategy.